Welcome to this explainer, where we're going to dive into the true math of real estate versus the stock market. You know, we hear it all the time, don't we? The idea that buying property is the ultimate, absolute, guaranteed ticket to financial freedom. But today, we're going to look at the numbers, the real, unfiltered numbers, and uncover the hidden costs of the real estate dream.
So let's start with a really crucial question. Is rental income actually the ultimate passive wealth hack? People online will casually toss around claims of 15 to 20% returns, and they rely on this super simple equation: rent minus mortgage equals profit. Well, I'm here to tell you that this popular equation is usually a dangerous solution. It's a massive trap that catches so many first-time investors because it completely ignores what actually happens after the ink dries on the deed.
To really show you how this plays out, let's meet Ethan and Lucas. Picture two 28-year-olds, both earning $65,000 a year. They've lived below their means, skipped the fancy vacations, drove the older cars, and they've each just saved their first $50,000. Obviously, that's a huge financial milestone, but they are about to choose very, very different paths for their money. Ethan wants something tangible. He's all in on real estate and leverage. Lucas? He just wants his money to work in the background. He's betting on index funds and absolute patience.
Okay, let's dive into exactly how they set this up. Ethan uses his $50,000 as a 20% down payment on a $250,000 house, locking in a 30-year mortgage at a 7% interest rate. Lucas goes a totally different route. He drops his entire $50,000 into a total stock market index fund, sets up an automatic monthly transfer of $200, closes the app, and literally just goes on with his life. No leverage, no tenants, zero physical property.
Right out of the gate, on day one, Ethan looks like the undisputed winner. He immediately finds a tenant willing to pay $1,800 a month, so against his $1,330 mortgage, he is pocketing $470 every single month. I mean, looking at that number, real estate feels like incredibly easy money, right? He can drive by the house, point to it, and physically see his wealth doing its thing. Let's fast forward 3 years. Over that time, Ethan collects roughly $64,800 in rent. Subtract the mortgage payments, and that adds up to nearly $17,000 in positive cash flow. Wow! But, and this is the absolutely crucial point here, that $17,000 figure, it really only exists on paper. It is the classic rent minus mortgage trap in full effect.
See, the very moment you own a rental property, you hit the invisible part of the iceberg. Suddenly, this huge laundry list of expenses quietly begins to eat away at what once looked like easy profit. Property taxes rise, insurance premiums climb. You get hit with cleaning fees, fresh paint, minor repairs, and the sheer cost of advertising and screening new tenants every time someone moves out. Sure, none of these are necessarily overwhelming on their own, but together, they just heavily, relentlessly drag down that paper profit.
And this brings us to a really vital rule of thumb for landlords. You must budget 1 to 2% of the home's value for routine maintenance every single year. On Ethan's $250,000 house, that means $2,500 to $5,000 just vanishing from his margins annually. A leaking faucet, a broken appliance, a water heater that suddenly dies, and it's usually on a holiday weekend, right? These aren't unexpected accidents. They are mathematical inevitabilities when you own a physical asset.
On top of that, properties don't stay magically occupied forever. Even the absolute best rental will eventually sit empty between tenants. You literally have to budget for at least 1 month of vacancy a year. Think about what that actually feels like in practice. That is 1 whole month where the mortgage still has to be paid, the taxes are still due, and the insurance is still active, but absolutely $0 of rent are coming in to help you pay for it. Ouch! Then comes the management dilemma. You can always hire a property manager, sure, but expect to hand over around 8 to 10% of your monthly rent to them. If you decide not to pay that fee to keep your margins looking healthy, you have to remember this massive hidden cost. If you manage it yourself, you are directly trading your own money for your personal time. Either way, someone pays. Rent is not profit. It's really just where the story begins.
So while Ethan is out there dealing with what we call the time tax, you know, those late-night phone calls from tenants, sudden plumbing emergencies on a Sunday, spending his lunch breaks meeting contractors, Lucas is experiencing something completely different. Lucas's wealth is quietly snowballing in the background with absolutely zero interruptions. He hasn't answered a single frantic phone call. His only job? Exercising patience.
Let's zoom out a bit to a longer timeline and see how this builds into a long-term reality. We saw year 1, where Ethan felt like an absolute genius. Year 3, the bills started rolling in.
But what happens over decades, as these relentless hidden costs just continue to mount against Ethan's rental income, while Lucas's index fund quietly experiences the magic of compound growth?
Well, let's look at year 10. This is where it gets super interesting. By this point, both investors have reached a surprisingly similar level of wealth. Ethan's equity is sitting between $165,000 and $200,000. But to get there, he's had to shell out roughly $30,000 on taxes, insurance, and maintenance just to keep his investment afloat. Meanwhile, Lucas's portfolio, assuming a pretty standard 10% average historical market return, is sitting right around $170,000 to $180,000. His effort expended? Literally almost zero.
Now for the grand finale, the full 20-year reality. After 2 decades, Ethan's total wealth is roughly $505,000. Lucas's total wealth is approximately $518,000. Their final net worth is practically identical. But man, the journey to get there couldn't have been more different. Ethan carried heavy debt, concentrated his risk in a single neighborhood, and poured hundreds of hours of sweat equity into his property. Lucas carried zero debt, owned tiny pieces of thousands of companies, and spent almost no time managing it at all.
Ultimately, I'm not saying one approach is automatically better than the other. The stock market comes with brutal volatility. I mean, we've all lived through 30 to 40% crashes, and it certainly doesn't offer the incredible leverage that real estate does. The true winner isn't determined by the asset class itself. The true winner is the investor who completely understands the money, the stress, the risk, and the massive opportunity cost of their own time.
So the next time someone insists that real estate is the ultimate passive wealth hack, or they try to sell you on that overly simple rent minus mortgage math, do me a favor, ask them one incredibly revealing question. Did you include everything? Because as we've seen today, the answer that includes everything is the only one that truly matters. So ask yourself, are you investing for passive income, or are you literally just buying yourself a second job? Thanks so much for joining me on this explainer, and I hope this helps you look at your next big investment through a much clearer lens.